Baby Live, and a very special edition today of your favorite show called Shut the Fud Up. That's right. Shut the Fud Up is what we're going to be doing here today, and here's what I want to share with you here first. Here is a little new intro that we got going on here, so check this out. Give this a listen.
Sometimes you just gotta shut the fuck up.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. And this current time is just one of those times you gotta shut the fuck up.
I don't think you're a bad person. I just don't want to hear you talking anymore. You gotta shut up.
There we go. Let's see. Was that playing? Was that something that like everybody could see? I don't think anybody could see that actually. So let's try that again here. I'm going to share the full screen.
Sometimes you just gotta shut the fuck up.
Hey man, just want to let you know that sometimes you gotta shut the fuck up. This current time is just one of those times you gotta shut the fuck up.
I don't think you're a bad person. I just don't want to hear you talking anymore. You gotta shut up.
All right. Everybody just kind of bear with me here as I'm like still learning the interface and getting it all working properly, because I know that like there's an easier way to do that, but Boomer Cairo here is still working on trying to figure that out. So we've got a ton of stuff to talk about here today. Just raising the screen up a little bit. There we go. Okay. I've got a ton to talk to you guys out here a bit today, man, and I got a special treat for you guys here today. Like, you're going to be seeing stuff on today's stream that like you never thought you'd be seeing on any crypto stream in general here. But first, why don't we talk about what's going on in the markets today, and let's talk about the most important metrics. So what I'm going to do first here is I'm going to share my screen with you all. And looky here, what do we got going on here? Oh my, it looks pretty bad here. Bitcoin has dropped below $110,000. So you know what this means here, guys, right? You know what it means? It means, oh, panic! Help! It's all over! Now we're going to have 4 more years of bear market. It's all over. We're poor. Right. I mean, like, Satoshi wrote somewhere in the white paper that if we have a little movement from 120,000 down to 109,000, what that means is you should sell all of your crypto. He wrote that somewhere in the white paper. I don't know where exactly he wrote that, but I'm sure it's there somewhere, right? Because it feels like that's what everybody is doing here, right? Oh, and Ethereum, apparently it just kisses its new all-time high and then goes right back down. I mean, that means it's all over, right? It's not like crypto has ever done that before, where it goes and kisses a new all-time high and then comes back down, retraces, reconsolidates for a little bit, and then goes on to new all-time highs. No, that never happens, right? Or how about some of these other assets right here? I mean, we're looking at some pretty gnarly drops here on Ondo, one of the crowd favorites. I mean, that's BlackRock's favorite RWA play. And that is down. If something like that is down, you need to calm thy butt, because that means nothing is going to escape the negativity in the markets today. So anybody's thinking, oh, it's the end of everything. No, we just have some negative forces going on. You guys should be celebrating this here, because now you got better prices to go scoop up some more crypto. Because look at these, man. These are some great prices. Like anything with Sonic at 30 cents right here, I'm definitely grabbing that up. Or what was the other one I saw? Caspa here at 8 cents. I mean, these are the penny coins that I keep talking about. If you follow the penny coin theory that I keep pushing, you should be really happy here today because you're going to scoop up a ton. Pith is another penny coin I really like. Let's look at the coins that we really care about here, though. The Richard Hart coins. We don't want to look at them on Coin Market Cap because they usually get it wrong. Let's have a look at them here on GoPulse. And oh my, Yeah, I'm afraid it's all over because Hex surrendered a penny and is now at 9.5 cent, or 95% of a cent. So yeah, it's all over there. No, never coming back, right? I mean, not to mention the fact that that it was lower before. It had previously been lower than a little under 1 cent. But now that it's under 1 cent again, apparently it's all over. Now, guys, these are some of the best penny coin plays that you could possibly dream of. This is something that should really put a smile on your face here. I'm not saying be happy that the prices are down. Like, yay, we lost some value. I'm not saying that. I was saying you should still be dollar cost averaging into these coins here because the bull run has not, I repeat, has not even started. Because the money printing that causes the bull run has not started. Get it through your thick skulls. Money printing is what causes the bull run. Has there been any money printing yet this year, this cycle? No, there has not. So please, shut the FUD up. So, what we're going to start doing here with my more regular streaming is we're going to have what we call Macro Mondays. And that's what today is, Macro Monday. We're going to focus on some macro stuff. So a few things we're going to do here today. One, we're going to give you some explanation as to why the market is down after it had a nice pop going up on Friday. We're going to talk about what's coming. We're going to talk about what's happening with the economy at a macro level. And then I'm going to show you a real treat that I got for all you guys here. Let's start with some treats here for you all. How about that? You guys want some treats? I'm going to give you some treats here. Let's start with this one. How would you like to have a free book? A free book that is going to add value to your life and is going to show you things that, it's going to show you things you believe or were taught to believe as absolute fact and to never question. And it's going to show you, hey, yeah, those things are actually wrong, and here's the right answer. And that way you don't spend the rest of your life believing in bull crap that's going to cripple you for the rest of your life. Well, you are in luck because you can get this book here 100% free. It's called Your Parents Were Wrong, Debunking and Replacing Outdated Advice. You can get it 100% free. It's not going to cost you a cent, not 1 cent. And I'm going to show you how you can get it for free. All you got to do is this here. You just got to go to my Substack, which I have over here. It is reinventideal.substack.com. And just click here right in the middle of the nav bar where it says free gift. Come down here. If you become a free subscriber on my Substack, free meaning it costs you absolutely nothing to be a subscriber on my Substack, you will get this book, Your Parents Were Wrong, 100% free, just by being a free subscriber on my Substack. All my articles on there are 100% free for you to read too, by the way. So you get that as well. Be a free subscriber, you get this book. If you want more than everybody else, though, if you want a better deal than you can possibly imagine, you can become a paid subscriber and get a second book for free. You get this one. It's called Don't Give a Shit and Succeed. Very special, fun read here. This is a great thing to read while you're on the toilet. Not just because of the title here, but it's something that's going to make you feel good after you do your business. And then if you want more than everybody else, you can become a paid founding subscriber, which we refer to as idealists, and you get this copy. You get a free copy of this book as well, No More 9 to 5. And you also get all of the other ones free. You get all 3 books for free if you become an idealist on my Substack. These are the things that I give to you here. I am the giving tree in this space here while Richard Hart is away. Remember, he was giving away free self-help books? Well, so am I here. It's all for y'all's benefit there. Now, what else do we want to cover here today? We got some more news to go over. So let's start with the headlines here over at CNBC, which is probably one of the worst sources of information when it comes to doing things for your money. Probably one of the worst sources. Like, I've never met anybody in the world that has ever said, oh, yeah, I'm a rich person because, I kept checking out what was on CNBC. I followed it right to the letter. And, man, the information that it gave me was just so pivotal and life-changing and such a great contributor to my success. Never once saw that. Let's have a look here, though, what they got to say about the current market movements. So, let's see. I think I'm just going to do, like, the whole window right here. Share that. All right. What do we got going on here? Warren Buffett just told CNBC his plan for trains. Well, we don't really care about that or what some dumb boomer's got to say. Trump says DOJ will sue California over redistricting. That's not really related to what we're doing. Markets are sure the Fed will cut in September, but the path from there is much murkier. This looks like an interesting story related to what we're going to talk about today. Let's have a look here at it. What does it say here? Friday's booming rally turned into Monday's reality check as investors weighed just how aggressive the Federal Reserve will be on lowering interest rates and how the moves might impact the broader business and economic climate. Chairman Jerome Powell, in his annual address at the Jackson Hole, Wyoming Symposium, gave Wall Street hope of easier days ahead when he said conditions may warrant adjusting our policy, which is generally seen as Fed speak for cutting rates. You see, we all have to translate what they're saying because they're just not going to say exactly what they mean. They just won't tell us that, oh, yeah, we think we will cut rates here and everything. It's always got to be this very measured, self-censored speech that they give out here. They can never just, say anything at all because if he had gotten up there and said, oh, yeah, I'm going to cut rates, but then later on they decide to rug it, well, he doesn't look like he went back on his word or anything. And while it was nice to hear at the time that he said, hey, we might change policy, apparently after the hangover Monday morning, we all woke up and realized, oh, you know something, he might not cut rates. As the story continues on here, stocks soared while Treasury yields plummeted. Oh, hey, wait a minute, whoa. That's an interesting story there, because not only did stocks soar, but crypto soared. But what else happened? What's the thing that I keep saying really matters? Treasury yields. Yeah, all of the dummies out there that say, oh, Cairo's wrong. He doesn't know what he's talking about. He's talking about very irrelevant stuff and claiming it matters, like the Treasury yield. We all know that the Treasury yield doesn't matter. This right here proves that you knuckleheads don't know what the FUD you're talking about, and I do. So please, shut the FUD up. This is proof that the bull market hasn't even started yet, because where are the Treasury yields at today? Let's have a quick look right here. Wow, look at that, 4.27%. You think we're going to have any sort of bull market at all when you got Treasury yields at 4.27%? If you think that, you are an imbecile. Back to this story here. However, cheer turned to caution on Monday as markets experts weighed what happens next, even if a move next month is baked in. Stocks were mostly lower, and shorter maturing Treasury yields, which are more sensitive to Fed actions, moved higher. Okay, so this is basically saying, well, now the market doesn't think it's going to happen. Really? Not necessarily. If we go to the CME and look at their predictions, and we look at the options that they got on this, they still have it at 84% chance that we get at least a 25 basis point cut, which is 1/4%, coming up at the September Fed meeting. That's what it says here, is that you get, we believe that this is what's going to happen. Now, it's still a good 3 weeks away. Anything can happen between now and then. Once it's the week of, a few days before, if it's still at these probabilities here, imagine it might climb higher if it looks like we're actually going to do it. But once it's the week of, if we still have this probability, then we can rest assured it's probably going to happen. But right now, being 3 weeks out, still a little too early to tell. So somebody said, I'm on the slower side more than the faster side if the Fed does go, said Jason Granite, Chief Investment Officer of BNY. He definitely moved the door ajar as opposed to kicked it wide open for September. That's this here. It says potential slow pace ahead. The implied probability for another cut in October was just 42%. Is that right? Let's have a look here at it. That's right, just 42%. I mean, it's still like greater probability that they would cut entirely in October. But they think that like if they cut in September, the majority thinks they hold it in October. Still, some people think there could be another cut coming in October. I think there's more to play for in the data between now and the September meeting, Granite said. So then the question will start to center around pace. Skeptics of a faster easing pace center their arguments around ongoing concerns about tariff-induced inflation, which there is none, and an economy that is holding up despite signs that the labor market is slowing. Oh, man. We got more than just signs that a labor market is slowing. We got hard data that you imbeciles are choosing to ignore. Yeah, all of you small penis economists, because that's exactly what you guys are. That's why you went into economics, because you knew you weren't ever going to get laid in college. So you're like, well, I may as well just major in something where there's not going to be any girls, and it guarantees that I'm not going to have any girls in my future, because, yeah, I'm clearly not going to get laid for the rest of my life. So I'm going to major in economics. That's exactly what's happening right here. If you don't believe me, go ask Aaron Clary. He'll tell you exactly what that's like. Although we are aware of the extreme political pressures on the Fed to ease, we acknowledge cracks emerging in some labor market data from our perch. The case for cuts looks modest. Yeah, speaking of political pressure on the Fed, two things that we ought to point out right here. One, Adriana, I forget the last name, one of the Fed governors. Her name was Adriana. She just up and bolted and left the Fed. That doesn't happen. You see, it's a very nice, cushy job to be working at the Fed, especially as a governor. So for somebody to just completely up and go, what that tells me is that she was afraid some dirt was going to be uncovered and brought to light on her. Because the very next day, they brought up dirt on the other Fed governor, Governor Cook. And what they showed here is that Cook committed mortgage fraud, which a lot of people do in this country. Lots of mortgage fraud going on where people say, oh, yeah, this is my primary residence, when really it's not, when they take out a mortgage. Very common thing. But the fact that they're going after Fed governors about it tells me that the president really wants these people on board with his agenda. These people don't want to be on board with his agenda, which is why they haven't cut yet. And they're saying, well, I'm going to force you. I'm going to send all my people after you, such as all the investigators. I'm not even going to send the IRS after you. I'm sure the IRS is going over their tax records with a fine-tooth comb. And that is why we had a little bit of a change in tone and a little bit of change of heart when it came to Jerome Powell on Friday's symposium. Let's skip ahead here. Worries over a repeat of 2024. Indeed, there are ongoing questions about the impact of Fed rates in the current climate. At this time a year ago, the central bank entered an easing mode that ended up having unintended consequences. An inverse move in Treasury yields and mortgage rates pushed by worries that the Fed might be taking its foot off the brake too soon with the expectations for stronger economic growth. Who had those worries? Anybody have those worries? I didn't have those worries. No, nobody had those worries. How about citing some sources here, CNBC? Of course not. That's the kind of consideration that has market veteran, maybe here they do, Ed Yardeni wondering about the wisdom of another round of cuts as he worries that Powell might be worrying about the temporary impulse of inflation from Trump tariffs. The Fed won't listen to me. Of course, they'll do what they're going to do, the head of Yardeni Research said on Monday. The cautious tale is what happened last year when the Fed lowered by 100 basis points and the bond yield went up 100 basis points. So basically what they're saying here is, yeah, they want to get the bond yields down, but cutting the interest rates doesn't seem to be doing that. And by the interest rate that they're talking about the 10-year Treasury, which, yeah, it matters. It matters. All you dummies out there that tell me it doesn't, no, it does. This proves it. They want to get the 10-year Treasury yield down, but all the cuts that they made previously were unsuccessful at getting it down. Good explanation for that, which we are going to explore today. Besides the 10-year Treasury, what's the other thing that really matters is the DXY. Let's have a look here at that. Remember this other dummy that told me it doesn't matter? Look at that. The DXY is up today, and of course, crypto is down. It's clear that there is a perfect inverse relationship here. So all of you dummies out there that tried telling me it doesn't happen, it doesn't matter, you are wrong. Thank you very much. So, got some more here to talk about. All right. What does he say? Sounds are different than usual, says Max. Let me see here. I can fix that. How about now, Max? Let me know. I think my mic got unplugged there for a second. Should be good now. Everybody, let me know in the chat if I sound normal, like I should be, or if the sound is doing all right. All right. So another thing here to cover is, what does CNBC have to say about the crypto market being down? We want to hear what TradFi's got to say here, because you see all the other streamers, particularly the mainstream streamers in crypto, they can't tell you nothing. They don't know nothing because they don't even know why crypto goes up. I mean, it's good now, Max? Okay, great, thank you. Because we know what they're all going to say. Like, if it's Ivan on tech, here's what he's going to do. He's going to go, yes, we are pushing the button. Publicans! Why is your coin down? I don't understand. It was supposed to do a 10,000x. And then Rand Nooner is going to get up there, and he's going to get his bubbles up there, and he's going to say, oh, let's have a look here at what's going on in the crypto world. What do we see here in the bubbles? Oh, nothing going on right here. Let me close out this thing that says Pulse. Let me close out this thing that says Hex. I don't want that. Yeah, nothing going on here in the crypto bubbles. Oh, I guess I don't know. And then you got George from Cryptos R Us, who sounds like he's constipated whenever he talks and gets up there and goes, welcome back to Cryptos R Us. I'm George. We're all George. Hold on, I gotta squeeze this poop right out of me. That's exactly what he sounds like whenever he talks. And none of them can tell you a doggone thing about what's going on or why anything is going on. So why don't we take a look here at what TradFi says? That way we can all have a really good laugh.
Bitcoin and Ether erased gains from Friday after federal chair Jay Powell hinted at upcoming rate cuts. Crypto exchange Gemini launches an XRP credit card, and we take a deep dive into how Wyoming has evolved into a crypto hub and the recent moves to help catapult the state to the next level.
CNBC Crypto World.
Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Crypto prices are in the red to kick off the week. As of noon Eastern, Bitcoin dropped nearly 2% to $112,186 after falling to the 110.
A lot lower than that right now, guys. But right now we're at like 109,000 on Bitcoin and like 4,300 on Ether. So this is pretty dated or time delayed. And of course, like XRP is at like 280.
$1,000 level over the weekend, its lowest level since July 10th. Now, Ether, it is pulling back after hitting a fresh record over the weekend. As of noon, the price of the second largest cryptocurrency fell under 4%. Meanwhile, dipped and investors returned to risk-on mode. Ether has been leading the crypto market for several weeks thanks to regulatory tailwinds, a boom in interest in tokenization, and buying in bulk.
I got a feeling that like they're not going to tell me why having to do with anything about this here. How much you guys want to bet that? They're not going to say a darn reason why it's going down. They're just going to be like, it's going down. We don't know why.
By a new cohort of corporate Ether accumulators like Bitmine and SharpLink. Now, that shift has helped support ETH, which has held onto the $4,000 level this month after unsuccessfully testing the resistance mark a handful of times since 2021. Okay, let's talk about the top stories. Gemini announced this morning that the crypto exchange...
Unbelievable. They got here. Unbelievable. Now they're going on to like the Gemini credit card. I used to have that credit card, actually. I used to use it a lot because like you got to earn rewards in crypto. And you could choose what would earn it in. So I was doing it in they don't have any of the Richard Hart tokens there, but I was able to earn it in some of the altcoins I like Filecoin, Sonic, and the Graph. But yeah, it's now that I got an XRP credit card here. I mean, like, I'll check it out. Maybe it's worth something. But anyways, I got a special treat here for you guys. I got what's going on in the markets, what went on Friday, reminds me of a song. A very special, like one of my favorite songs here. And I can't play it because I'll get copyright strike. But you know what I can do is I can play it if I play it by hand. So I saw over at Maddie Allen's conference that, what's her name? I think it was Hod Pearl. Yeah, Hod Pearl was playing her ukulele. And I got a ukulele here, but I don't know this song on the ukulele, but I know it on guitar. So I'm going to play a song here for you guys. You tell me if you know this one and see if you can go ahead and guess how you think it's related. Here we go. All right. That was just me starting up right here. Let's try it. Let's go. Take it right from the top. Painted black, no colors anymore. I want them to turn back. I see the girls go by just in their summer clothes. I have to turn my head until my darkness goes. I see a line of cars and they're all painted black. And my love look never to come back. I see people turn their heads and quickly look away. Like a newborn baby, it just happens every day. No more will I find myself and see my heart is black. I see my red door, I must have it painted black. Maybe then I'll fade away and not have to face the facts. Not easy facing up when your whole world is black. No more will my green seagull turn a deeper blue. I could not foresee this thing happening to you. If I look hard enough into the setting sun, my love will laugh with me before the morning comes. I see my red door and I want it painted black. No colors anymore, I want them to turn black. I see the girls go by just in their summer clothes. I have to turn my head until my darkness goes. Wanna see your fade, painted black, black as gold, black as night. I wanna see the sun blotted out from the sky. Wanna see you painted, 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 painted black. Yeah. So if you were able to recognize that song, despite my butchering of it there, because I'm not Mick Jagger, if you're able to recognize that song is Paint It Black by the Rolling Stones. Why am I singing Paint It Black by the Rolling Stones? Paint It Black is not a cheery song. It is actually a very dreary, dreadful song talking about horrific circumstances that the protagonist of the song is coping with. It's a coping mechanism. And by the way, you want to know what I think is one of the most low IQ comebacks that I see all the damn time on Twitter? You're coping, man. You're coping. Okay, your point? Oh, that's a cope, man. Your point?
I mean, evolution is a cope. Coping is what we do as humans. That's what life is. We adapt because there's no progress without adaptation to the situation. But still, all these low IQ imbeciles are going to go, you're coping. Especially you, because your name's Cairo Copeland. You're coping. Oh, and there goes your IQ. I'm already subtracting 100 IQ points from it whenever you say stupid stuff like that. It's like, you may as well, I can't think of anything else to say. I can't come up with a good comeback. You know what I say about that? Like, hey, if you want a good comeback, why don't you just stick your fingers further down your throat? That's guaranteed to get you one. Anyways, where was I? Oh, yeah. So that song is about coping with the world. When grief shows up, the protagonist of that song dulls the world's color on purpose. And that is specifically what the Chairman Powell did at Jackson Hole. Inflation remains sticky, but the bigger fear is the labor market's downshift. So the policy brush is dipping towards a darker, easier hue. Markets heard the subtext on Friday that conditions may warrant cuts, with explicit nods to a rising labor market risk. Yields fell and equities popped. And for that, we have our first chart. Let me show. I got a lot of charts here for you guys today. So let's pull up chart number 1 here and get that going for you. Where's my chart? Where did I put it? Here it is. I think this is it. No, that ain't it. There it is. Or no, is that? No, that ain't it. This is it. There we go. I think you guys can see this chart here. The continued claims of unemployment insurance. See, a lot of people want to look at the unemployment rate. But you see, that's only measuring the people that are currently looking for work right now and can't find it. It doesn't really take into account the people that have been unemployed for a long time and are receiving unemployment. That's why we really don't like using that as a measure of how healthy the jobs market is, because it barely covers anything important. It barely takes into account the full picture. It doesn't take into account the full picture. So Fed Chair Powell struts into Jackson Hole like a weary dad at a family barbecue, muttering about sticky inflation, but really fretting over the jobs market going face down, booty up. That's what's happening with it. Inflation's hanging around like a guest that just won't leave the party. You all had that. You threw a birthday party, and there's just like that one really annoying friend that got really trashed and won't go away. That's inflation right now. But the real nightmare is this. Unemployment keeps creeping up. Continued jobless claims are knocking on 2 million, the highest in 4 years from the early 2025 levels. If you saw me at Hex Week, I showed a whole bunch of charts that support this. Whole bunch of data that shows like, hey, the economy's in a recession, guys, even though we all don't want to admit it, or none of the politicians or people in power want to admit it. The economy is, in fact, in a recession, and all of the data supports that assertion. So what that's done is that's given Powell the ability to make this little change to the Fed's monetary policy. There's some little things here that they changed that weren't in there before. It says, in the near term, risks to inflations are tilted to the upside, and risks to the employment are to the downside. A challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to the neutral than it was a year ago, and the stability of our unemployment rate and other labor market measures allow us to proceed carefully as we consider changes to policy stance. Nonetheless, with policy in restrictive territory, and here's another change they made, baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Let's translate that for you all from bullcrap to English. It says conditions may warrant cuts, with a big neon flashing sign that says labor risks are rising. What markets heard was loud and clear, cuts may be coming, and that's why yields tumbled. They wanted to front run that. That's why stocks popped like champagne corks. That's why crypto took off, because that was front running the potential for cuts. And then, of course, today everybody decided, oh man, maybe we got in like way too early right here. We should pull right out. It's paint it black economics. They're deliberately dimming the lights to stop the whole machine from seizing up. But let's not kid ourselves. We're in a recession, folks. Everyone's ignoring the data like it's an ex's text at 2 a.m. But coming up here, this upcoming month, September, you're not going to be able to ignore it anymore because we got jobs revisions, job estimate revisions coming up. You see, May and June alone slashed about 258,000 jobs that they said were there, but they really weren't there. They either measured improperly or they lied. And 258,000, that's the population of Scottsdale, Arizona. And so far this year, 461,000 jobs have been revised down. The Labor Department's weekly data is screaming this here, but we're all just playing charades with the economy. But the Fed can't afford that game. They've got to act, or the negative feedback loop is going to turn into a full-blown death spiral. It's going to be like that Nine Inch Nails album, the downward spiral. So, you don't hear recession in the news or anything because they don't like using that word there. As a matter of fact, there was all throughout last year, I kept seeing this all over CNBC, and it made me so angry every time I saw it. They said, oh, well, we're not in a recession, but, we're in a vibe session. It's a vibe session. Yeah, the vibes that we're feeling just ain't that great. Man, it'd be great if we could have some good vibes here. Man, that made me so angry to see that. I was like, people out there who are struggling right now, and life is really hard for them. But these dildos over at CNBC are going, oh, don't worry. It's just a vibe session. They just feel bad vibes, but there ain't really a recession. And all that was just cover for Biden because it was pre-election. Anyway, back to where I was here. We all know about the Fed's dual mandate, right? This will help you understand why Powell is flipping the script here. Because remember, they have to keep unemployment low. They got to keep inflation and deflation in check. Got to keep the reins on it. Since 2021, they've been laser focused on inflation because that's when the official measure they use kicked all the way up to 9%. They started hiking rates like they were trying to win a contest with a volcano. But here it was the twist. They got to focus on jobs. The Fed doesn't really have much control over jobs. Their only trick when it comes to influencing employment or unemployment is inflating the money supply to make minimum wages laughable. As like I say, we got minimum wage at $15 an hour. What they could do is they could inflate the money supply to cause lots of inflation, really kick it up, and then that $15 an hour is no longer good enough to live. It doesn't allow them to live. It doesn't cover expenses or anything. And so what has to happen then is those companies that pay minimum wage either have to raise their wages or they got to lobby politicians, and politicians got to force them to do the raising. And now that they have to pay higher wages, they can't employ as many people. So it forces politicians to hike them, which then axes jobs and spikes unemployment. Does that sound familiar any right here? I mean, it's kind of like the situation that we're living in now, doesn't it? Yeah, it sure does. That brings us to our next chart here. PPI, Producer Price Index. Take a look at this here. In the red, this shows us that the recent measure of it for July is the highest one that we've had in about 2.5 years. Very gnarly, very ugly right here. And what this is, a lot of this is like tariff-induced. It's not the consumers that are paying this, though. It is the producers that are paying this. They're absorbing those costs themselves. So there's not like tariff-induced inflation that you and I are paying, but tariff-induced inflation that like Walmart and Procter & Gamble is paying. They're just eating those costs before passing them on to the consumer. They can't do this forever. At some point, they're going to have to pass those costs along to the consumer. At some point, they will have to. So this tells us that inflation is not tamed. The core CPI is above 3.1% in July. PPI is up month over month, and it's the biggest since probably the year 2022. Yeah, according to this chart, since 2022. But the labor market is cracking like an egg here, and that's leading to that's bringing the leading indicators for a recession to start crumbling and start confirming, yeah, the economy is about to take a dump because the jobs data keeps getting revised negatively. They keep overestimating the jobs data, how many jobs we add to the economy. They keep overestimating it, and then they got to revise it downward a month later. So the Fed's preparing to cut rates while we're going into inflation. And let's talk about those revisions here. That's what this chart here says. Look at this over in the red box. Look at this. 1.4 million jobs they overestimated that we as an economy, as a country, don't even have. They said, oh, yeah, we got the jobs. No, we don't. No. They had to do revisions to back them out. So either they're lying when they come up with these initial estimates, or the tools they have to measure them are just not good tools. All right. So September is pricing in the CME is pricing in or betting on a Fed cut for September because of this here. Because coming up, September 5th, I believe it is, when the re-estimates come out, when the revisions come out, we're expecting another negative revision downward. All right. Right now, the Fed Watch has got the rate cut probability at 84%. Stocks and crypto love that. They absolutely love that. It's like handing them a free round at the bar. But here's the rub. We got inflation, but we're going to have rate cuts? Usually, the Fed doesn't like to do that. They don't like to mix those two things. That's something that those two things don't go together. But rate cuts, while there is inflation, you know what that does for risk-on assets? It's like rocket fuel for them. I mean, let's put crypto aside here for a moment and focus on TradFi. How about the S&P 500? The last 20 times that the Fed cut was within 2% of all-time highs in the S&P 500. You can see it kind of right here with this chart. What this shows is like all the rate cuts that they made here had occurred within the gray areas because those were recessions and they cut to get us out of recession. And then sometimes like they make the cut before the recession is officially announced. And we go down. Like at first when they make the rate cut, asset prices go down. But then what happens next? What goes on for the next couple of years is the asset prices climb. They start going up for an extended period of time. You know, like right here, 2001. I mean, this was 9/11, I think, is what this was a reaction to. They had to cut the rates to reinstill confidence in the market to get people to invest again, because a lot of people were thinking, oh, this is the end of the world. This is the end of America. Then over here, 2008, they started cutting before, and then we had the recession come in. They knew a recession was coming. They knew it because we had an inverted yield curve, so they started cutting. And then down the rates go even further. Down asset prices go even further because this was that horrific great financial crisis, and the stock market didn't really bottom until about March 2009. But since then, look at this. Woo, man, we had a good 11 years, at least a good 11 years of positive market action. And then you got COVID, a very short-lived recession, and our new highs here from it. All right. This is very typical for the Fed to cut when we're at all-time highs. That causes us to do a retrace, but then after the retrace is done, it's up only for a while. And here's a chart that kind of shows exactly that. What this shows you is like, how far away were we from the all-time high when they made the first cut? That's what this column tells us. And for the most part, it was less than 2% away from it. The next month, on average, we didn't really do all that great because a lot of times it goes down. You see, like this one right here, 1986, It went down 8%. 1990 went down 8%. Then some of these other ones, it was a little more moderate. Like 92, it was just 2.4%. But on average, we gained about 0.1%, which is bearish in stocks. But then the next 3 months, we're up 2%. In stocks, that's a big deal because that's trillions of dollars. The next 6 months, we're up 3.4%. And then for the next year, stocks are up at least 13.9%. That is incredible for stocks because what we're used to with stocks is just making 9% on average each year. So to get 13.9%, that is a lot. Crypto, on the other hand, is a leveraged play on the stock market that does about 4 times the percent returns that the stock market does. So in crypto, I'd be looking at like a 50% return for the next year. And that's like across the entire market, across the board, not focusing on any one particular crypto. So this is incredibly bullish when they start cutting. Incredibly bullish. All right. Because every time that they do, even if we're already already near an all-time high, like we are with Bitcoin right now, like we are with the S&P right now, and even while we got inflation, it still does very good for us. Let's look at some of the other risk-on assets right here. Bitcoin and gold. Since 2023, all right, since like the bottom of the bear market of 2022, really, if we want to look at that, like November 2022, we're up 450% on Bitcoin. Gold has doubled in price as well. Those risk-on assets are up over the last 3 years. Gosh, because, if I don't invest, I don't participate when the market goes down, so I don't lose nothing. No, you are losing something. You're losing about 5 to 10% a year, guaranteed. As inflation is eating away at your cash's purchasing power. And this is why you have to invest. And the best hedges against inflation have been gold and crypto, as it beats inflation. Sometimes stocks can do it too. Sometimes stocks have a good year, but roughly, I think like the annual return that the stock market gets, that is the real inflation rate, in my opinion, because the only thing that's pushing the stock market up is money printing. That's the only thing that pushes it up. And it goes right in line with how much money they add to the system. Whereas crypto, because the liquidity is so small, because it's so low, it makes exponential jumps in its gains. You see, the stock market, those gains are linear. It's not exponential, it's linear. It only gets exponential when you factor in compounding, but the gains that the stock market gets are pretty linear. The gains that crypto gets are exponential, which really outpaces inflation. That's why we like crypto more than we like stocks. But what this is showing you here is that asset owners, they're going to party like it's 2021. You remember those days? I remember those days. Those were great, great days. Yep. Wage growth, it's going to lag, I'm afraid. And here's another reason why you really got to invest, guys. The wealth gap is going to get worse, a lot worse. It's going to yawn wider than I do when a politician makes a promise. That's how bad it's going to get. We're talking like historic levels. Why don't we have a look here at some history? Do I have any? I don't know. Maybe I do. But I think like back in 1990, the gap between the top 1% and the bottom 50% was $3 trillion. I only remember that because that was something that Ross Perot would never shut up about. Now it's around $40 trillion, the gap between the top 1% and everybody else. So if the top 0.1%, so not even top 1, but the upper 10th of the top 1%, they hold 5.5 times more wealth than the bottom half. The last time that the Federal Reserve cut rates while we still had inflation, that was the 1970s. And here's what that looked like. This blue line shows what was going on in the 70s with inflation. All right? That's what was happening there. And then this sort of green-looking line, this is CPI right now. You see there's 2 years listed down here at each point. This is where we're at right now, 2025. it's kind of mirroring what it was like back in 1977. Like, if we want to know what inflation is going to do, take a look back at the 70s, and that will tell you. I don't really want to look back at the 70s, though. The 70s was not a. I don't think that was a great time to be alive. Like, the 80s looked pretty fun. Everybody was hot back then. The 90s, oh my gosh, the 90s, those were great times. Everybody was really hot in the 90s, if you remember. Like, I was watching. There's this great. I used to be a wrestling fan when I was a kid. There's this channel on YouTube that's just all WCW. Like, that was the one that I really liked at the time, like before the Attitude Era and everything on WWF. So I was watching some WCW from the 1990s, and looking at the audience, it was actually all good-looking people. And I don't see any good-looking people when I go walking around in public today. I'm like, what the hell did they all go? But back in the 90s, they were all hot. Those were good times. What am I saying all this for? Yeah, the 70s, I don't think they were that great of a time to be alive there, because all it was just drugs, boomer music, and clothes that guaranteed you didn't get laid. I mean, you seen the bell bottoms? They look so horrific. And you couldn't buy any straight pants in the store back then. It was all bell bottoms. And that you had to wear them in order to be cool. So back in the 70s, we also had stagflation. Now, I don't think there's going to be 15% inflation yet. But when you stimulate demand in an economy that's figuratively already hot, where asset prices are already high, that's going to be like pouring more petroleum on a barbecue grill. And what happens there is the rich get richer, and the rest, everybody else, just gets squeezed. And it's not just in the United States where we got this problem here. You see, global banks all around the world, such as the ECB, Bank of Japan, People's Bank of China, they've already begun slashing rates like they're in a sword fight. I think I got a chart here that shows that, right? No, wait, this here? Yeah, this also shows like the gap between the top 1% and the bottom 50%. So from the 99th to 100th percentile is the blue line. And then the 50th, the 50th percentile is the red line. Better off, but nowhere near as much. And that's largely just because they don't own any assets. This should be like your onboarding tool here for getting people into crypto. Look at this here. This trend is going to continue. And the people that are in blue, those are people who own assets like crypto, like stocks, like gold. I can't buy gold because it's too expensive, $5,000 an ounce, so I can't get a whole piece of gold. And stocks, I mean, I could do it figuratively, but it's not that easy to get into stocks. I mean, just opening an account at some of these brokers is a pain in the butt. I tried opening an account for a friend recently. It was a big pain in the butt. But you know what's pretty easy? Is getting into crypto. Yeah, it's got KYC. Yeah, it's got AML at the centralized exchanges. But you don't have to stay on the centralized exchanges. You just deposit some money onto Coinbase and you can immediately get it right off. Get it onto your Trezor and then just use DEXs from there on in. This should be your onboarding tool here when you're telling other people about crypto. Is be like, do you want to be in the red or do you want to be in the blue? Because you probably heard this phrase before. They say it's a K-shaped economy because with the pandemic, we had what was called a K-shaped recovery, which you kind of see right here with the pandemic drop. It goes bloop and then bloop. Whereas down here at the bottom, it stayed kind of flat. So that's kind of like a K that's flipped over on its side, is what they're saying. It's a K-shaped economy. But I tell you, if this trend continues, it's going to be an I-shaped economy where you just have all these people down here that have no assets, and it's like the majority of the population. Then you got all these people up here, a very tiny percentage of them, that have all the assets and control all the wealth. Like that line that Richard says in The Highest of Stakes. Those who understand this are going to control everything, and those who don't understand this are going to work for the ones who do. You want to be the people that do understand this. You don't want to be working for the people that don't understand it, or working for the people that do understand it. All right? This is where the I-shaped economy really begins. But what I was saying before here about central banks, other central banks all around the world have begun their cutting It's just ours here in the United States that is being stubborn and is trying to avoid doing the right thing or doing what the economy needs, which is cutting. They don't want to do it because there's still inflation going on. Now, part of it is like there's always going to be inflation because we can't allow deflation to occur, and they never will. There's a great paper written by Ben Bernanke. I don't really like Ben Bernanke as a Fed chair, but he is a good thinker, and he had written this great paper about like why we can't allow deflation. Because if we allow deflation, it's going to crash the economy. The deflation means prices are coming down. So cars are going from $40,000 a piece to $35,000, then to $30,000, then to $25,000, then to $20,000. And you see, the problem there is if you know it's going to keep going down, you don't buy, you stay on the sidelines, and you keep watching it go down more and more and more. And it gets easier to stay on the sidelines and watch. And if like everybody's patient enough, I mean, we can get cars for $5,000 again. That'd be great. But the economy is going to crash in that case. They're not going to let that happen. So May 2025 alone, there was 15 cuts from central banks all across the world. That's one of the biggest waves that we've had in ever since the turn of the century. The Fed is going to have to play catch up. Remember what I kept saying all throughout Hex Week is that the longer they delay a cut, a Federal Reserve interest rate cut, the more powerful the impact of it is going to be. And that's also because the Fed's going to have to be playing catch up with the rest of the world. The whole world's economy is going to feel this heat. All right? You guys feeling the heat there in the chat? Let me know. All right? But here's another thing here about inflation. Like, it seems like the Fed is surrendering on inflation. You look at their policy change and the statement that they put out about why they're changing the policy. When you look at that, it looks like they're surrendering on inflation. Is it possible that they're doing that because they've been fighting it the wrong way this whole time? You see, usually you raise rates when you want to kill inflation. When you want to tamper it down, you would raise rates because the deal is, well, if you can earn a high rate by saving your money, you wouldn't spend it. That tampers down demand for items while the item supply remains the same. So the lower demand forces them to lower the price of those items. And also, less money in circulation would mean there's less to go around. So to get more of it, you need to lower prices. But what about this here? You seen this chart yet? Oh, wait, not that chart. Here it is. Cap rates. That's what this is here. This is a cap rate. If you wanted to get into real estate and you wanted to make a return on, say, apartment buildings or, say, commercial real estate, plazas, office buildings and everything, what you're going to be looking at is the cap rate. Because what the cap rate tells you is how much return you're going to get on your money. If I buy this apartment building for $10 million and my cap rate is 5%, I'm going to get 5% a year on that $10 million that I spent, and it's going to take me 20 years to make my investment back. All right? That's cap rate. Very important in the world of real estate. But what this chart is showing you is that the cap rate is right in line with the Treasury, because you've got 10-year Treasury bills that are roughly at the same, offer the same return as real estate cap rates, because real estate is so expensive right now. It makes no sense then to go buy real estate and invest in that and take on the risks and the stress of managing tenants and maintaining property when you could just buy a Treasury and not have to do anything. You just sit back and collect your interest. This is why that 10-year Treasury matters so much. This is why Treasuries in general matter so much, because they're perceived as risk-free. You don't have to do anything to earn the interest other than buy them and hold them. And if it's paying you 4.27% like it is right now, and the cap rates on real estate, hard to manage risk on assets, is 4.27%, you're not going to do no real estate. Or what you might do is this. You see, like, why is the Treasury rate where it's at? Because the Fed raised rates. They raised the federal funds rate, and that pushed up the Treasury rates as well. But now, you think that all of these landlords out there that own apartment buildings, you think that they're going to just sit there and take it like good little boys? They'd be like, oh, man, we only get 4% return on our investment here. Oh, man, that really sucks. We're just going to have to sit here and take it. We're going to keep doing all the hard work that we have to do to manage this property and manage our tenants, even though we could make the same rate without doing that kind of work. Yeah, we're just going to have to sit here and take it. Is that going to happen? No, that ain't going to happen. You know what they're going to do? They're going to raise the rent. I say, we're taking risk. We're busting our butts off managing this property. We need to make more than what a treasury would pay us. So that's what they do. They raise the rent. How's your rent doing? Has your rent been raised? You tell me in the chat. Has your rent been raised? My rent got raised. And it's not just my rent. It's not just residential rent. It is the rents of commercial real estate. So all the stores out there, I mean, not all of them own the buildings that they operate in. They rent them. I mean, when I ran a business, I didn't own the real estate, the little unit in the plaza that my laundromat was in. I had to rent it, and the landlord could raise that rent whenever he wanted to. He had the right to do it. And if he wants to make more than a treasury, of course, he's going to raise that rate. And when we business owners get our rents raised, you know what we do? We raise our prices. We pass it along to the customers because everything on the shelves at the store has to go up to cover the increased cost in rent to house the stuff on the shelves. What about oil? You see, the oil companies, they got to take out loans at these high rates that the Fed pushed up to finance their drilling operations. When they have to pay higher expense, especially interest expense, do they just sit there and eat it? Do they go, oh man, the Fed says that we got to pay more interest expense? Well, I guess we'll just have to do it. Do they do that? No, let me show you what they do. Where is it here? It's over here, right? Yeah. Up here on CNBC's website, look at this. Oil says unchanged right now, but that's because it's looking at the futures. What was it doing today? Today is, the 25th? Yeah, so this is an increase. It's up on the day. Oh, we said it over here. You see this? This is today. Look at that. It popped up. It is up today. They're raising oil. I remember this thing was like down around $60 a barrel. Now it's $64.80. And that's got to do with the fact that they got to borrow money to do their drilling operations. And because they got to borrow money to do the drilling operations, they got to pay the higher interest rates on their borrowed money. And because they got to pay higher interest rates on their borrowed money, are they going to absorb the cost? No, they're going to pass it along to you. So now, when oil goes up, the price of everything goes up. Everything at the store, because it costs more to get there at the store. So what am I bringing all this up here for? Is what I'm trying to say is that these higher rates, they probably don't even help with inflation at all. At least not in today's environment. Because what it's doing is it's just making business more expensive to do here in the United States. It's making just paying your rent more expensive. It is a passed down expense. The interest rate expenses are being passed down all the way to the consumer. This is also what causes that I-shaped economy. Because you see, the guys that are at the top of the I, they're the ones that get to pass down the expenses to everybody at the lower end of the I. And this is why the wealth divide is as bad as it is and why it's getting worse. And what I hope the Fed is learning or has learned is that maybe interest rates help with inflation at all. Maybe it causes inflation. Because what does help is having more stuff produced, more goods and services. Remember from the movie, Highest of Stakes, the only real money out there is goods and services. Everything else is accounting. If we have more goods and services being produced, that can absorb the new dollar bills being printed and pushed into circulation, and that tampers down inflation. You see, the reason why the 2021 inflation was so incredibly bad was because we literally paid people not to work. We paid people to stay at home and not work. So we took people off of the lines. They're no longer producing. We took them out of the factories and paid them to stay home. We produced more money, we produced more dollar bills, and we gave it to these people that we were paying not to work. So less stuff got produced, more money got printed, but there's less stuff in the economy to absorb that money and give it value. Which, let's see, back to my charts here. Where's my, this is our chart I was looking at. There's a chart that shows this here. Is it this one? Not this one. Gotta go back to, I think it might be this one here. Yeah. All right. So this is why the I-shaped economy might be happening here, especially if a recession hits. I mean, we're going to be in denial and all, but rate cuts are coming because they really have to be coming. They really got to start giving those rates. And that means that stocks, Bitcoin, and gold will soar when it happens. At first, they might go down at the first rate cut, but then they will go up because that's just usually how it goes. But the real story is just this disproportionate, lopsided distribution of wealth that is going to be happening. The inequality. I'm not a Democrat. Or I'm not a Democrat. I don't really care about income equality or wealth inequality because, like, if you earned it, you deserve it. If you are just a lazy bum, then you don't deserve it. But here's where I bring this up here is that the reason we have this is because you got just a small portion of the world, particularly here in the United States, very small portion of the country that is investment literate. I mean, there was a very investment illiterate imbecile I was arguing with on Twitter today. And that's the majority of the United States is investment illiteracy. Very small portion of people have literacy in investments. And that's what makes them part of the dot in the I-shaped economy that's coming. All right. And when the Fed cuts rates, it's going to make that spread between the two worse, the haves and the have-nots. See, the Fed, they're behind in the global rate cut cycle. And when they start playing catch-up, it really helps the people that already have assets. Now, when I talk about what's coming here in the United States when the Fed does start with the rates and everything, when they do start reducing the rates. This is something I wanted to show here about the economy, how much of it is coming now from government. Almost half of the economy is from government spending. I'm going to get into a little bit of that here, like, why it's a bad thing for most people, but why it's a good thing for everybody else that, like you and me, that is holding crypto and assets. It's a bad thing for everybody else, actually, but it's a good thing for us holding the assets. And this is why you need to be investment literate, because this is a system where the average hardworking man can't win unless he's investing. That's the system that we've created. Think of like the government as a deranged python that is eating its own tail. There's like a cycle of just fiscal idiocy. That is going to be this chart here that we want to talk about. I posted this here on my Twitter. You find me on Twitter at Reinvent Ideal. By the way, Reinvent Ideal is the username where you can find me on everything. The YouTube channel now is just called Reinvent Ideal. You search for that, you'll find me. And you'll find me there on Twitter and on Substack, all Reinvent Ideal. The reason I chose that name here is because what I'm wanting you to do is reinvent the ideal life here for yourself by becoming investment literate. But like, instead of pursuing the things that the boomers told you to do, like, oh, go to school, get a good degree so you can get a good job and work in corporate America and do that for 55 years, and then when you're 75, you can retire and enjoy life. I say Reinvent Ideal is no, say screw that. I ain't doing that. what I'm going to do is I'm going to focus on learning very solid in-demand skills. I don't even need to go to college to do that. Because like right now, the railroads are hiring, and they'll hire you without even any college education at all. They'll train you, and those are in-demand skills. So in-demand skills, minimalism. You don't need to be buying a whole bunch of crap to piss off the Joneses or your next-door neighbors that you secretly hate, but you're trying to impress them for some reason. And then crypto. You get your in-demand skills to make money. You keep more money than you give up because you practice minimalism. And the money that you keep, you put into crypto so that you can minimize the amount of time that you have to spend giving up your life working. That's what Reinvent Ideal is all about. So this was on my Twitter, which is a handle now is Reinvent Ideal. This is what we want to explain here to you is the U.S. economy under the government, the way everything is currently ran and has been ran for at least the last 50 years, is a snake eating its own tail. Let's explain to you what that means here. The first step is the U.S. government issues treasuries, those fancy IOUs that suck money out of the private sector. Because when they issue the treasuries, people from the private sector come and buy them with their own money. That's private money buying them. Investors hand over their cash, thinking they're being savvy. Then comes to step 2, which is where the government takes that loot and flings it back into the private sector. So this is like how stupid everything is right here. So for over here, like they sell bonds, collect money from the private sector. Then down here, all they do is they just send that money back to where it came from, the private sector, where they do the investing, like infrastructure. You always hear that whenever a Democrat has been elected. It's like, oh yeah, we're going to invest in our infrastructure. But still, everybody does this here. Like both Republican and Democrat administrations or Congresses, they all spend on, they all go out of control spending because they have to. They have to keep the economy afloat. Because you see, 44% of the economy is government spending. So if they cut that down, it would hurt the economy because it's so dependent on that spending. Here's where it gets uglier here, though, is like they raise the money up here, then they spend the money. This takes it out of the private economy. This puts it back into the private economy. Now, over here, it says ideally they would spend the money wisely in the private sector, generating a positive return on the investment. That rarely happens. Like, have you ever heard of Solyndra? Remember that scandal way back when Obama was president, where they just pissed away a whole bunch of money on a company that wasn't worth a damn because it sounded good? Oh, it's solar power. That's going to be good. So typically the money that the government spends is money that they waste on crap that the economy doesn't need. It just employs a bunch of stupid people that were too lazy to learn an in-demand skill. So money's back in the economy. It's being wasted. And then over here, the tail of the snake is the government taxes the same private sector to pay back the bonds over here that it issued and also pay it with interest. Now, they do not collect enough money in tax to cover the bonds and the interest. So not only is the snake eating its own tail, it's got a bigger problem right here. I'm not even sure like what the best analogy for this would be here. So as you see, because they don't spend the money wisely over here, there's not enough money to go around to tax up here to cover everything that they did over here at the head of the snake. It's because they waste the money on stuff that doesn't help the economy grow. They waste it on stupid stuff. Some stuff they spend it on helps the economy grow, I'll admit that. But a lot of it that they spend it on does not help the economy grow. I'll get into it in a little bit here. But I want to show you this visual here of a snake eating its own tail. This is how the U.S. economy is run currently. This is why we don't have the good old 4% almost growth that we had back in the 50s. A lot of the economy is just the government pissing away a bunch of money. All right? So to pay back those bonds, plus interest, they tax the ever-loving snot out of the private sector. Round and round we go, like a merry-go-round of extraction and redistribution that's running at a massive deficit because they can't tax enough money to cover the bonds. And what they got to do then is they got to issue more bonds to cover the shortfall. That's deficit spending. And because if it stops, the whole rickety contraption collapses like a Jenga tower built on a seesaw. So you see the absurdity? The snake eating its own tail? The snake eating its own tail here. This is government handouts like they did back in COVID. This is cash for clunkers like they did back during the Great Recession. Bailouts of the banks. That's what all this is here. And now the government just took a 10% stake in Intel. And they say they're going to take stake in more companies. So we're literally marching towards communism, or at least socialism, and like national socialism, where they're nationalizing private companies. And why 10%? You ever curious, like, why is it that they did 10% of Intel? Because that makes you a control person. If you're an officer or a director in a company, or a more than 10% shareholder, you are a control person of that company. Now they can control this company. Owning 10% of the outstanding shares gives you enough power to have control over what the company does. You got a lot more voting power than the average rank and file shareholder. So they may as well control most companies because of how this country's economy functions. 44% of our economy. This chart here again. How much of our GDP comes from government spending? 44%, almost half. This sucks. It's not good. But there's nothing we can do about it. Nothing we can do about it. Because the economy will collapse if they try to cut back on this madness. The deficit machine can't shut down because too many people, especially us millennials, we were too busy faffing about with liberal arts degrees, myself included. I got a useless degree in acting. Because I'm going to be honest with you, this is how you know I'm telling you the truth. Because when I tell the truth about myself, it doesn't make me look good. I was lazy back in college, and I didn't want to do hard stuff like math and engineering. Also, I was told by my parents, by my teachers, by my guidance counselors that, hey, this is America, and you can be anything you want. And so I'm like, well, I want to be an actor, so I'm going to be able to be an actor. You probably heard something similar, right? You guys tell me in the chat. Did you hear something similar? That, oh yeah, you can do whatever you want in this country? Anybody else heard that? Because you see, here's the thing. Here's the thing here. There's only one person in the whole world. Only one person in the whole world that gets to do what they want. Anyone know who it is? Now you tell me in the chat if you know who it is. There's just one person that gets to do whatever they want. Give you a moment right here to think about it. Matter of fact, let me go grab another drink. You guys put in the chat there. Who is the one type of person? It's not just one single person, but who is the one type of person that gets to do whatever they want and is the only person in the world that gets to do what they want? You tell me. I'm going to go grab another drink. Oh, hey, I want to say this here. All you other streamers out there that have a drink while you're streaming, look what I'm doing. Did you see that? You see what I just did? Yeah, you do that too, all right? If you're going to take a sip of your drink, step away from the microphone so that we don't hear you making disgusting sounds with your mouth. You people know who you are. This is agonizing to listen to is people that chew with their mouth open, which needs to be designated as a hate crime. So I want Pam Bondi to go on here. Like, they just made it illegal to burn the American flag. I'm like, hey, you know what? I'm fine with you guys doing that as long as you make it a hate crime, punishable and a federal offense, punishable by life in prison for chewing with your mouth open. All right, so now that I'm back here, I'm going to ask you this here. Right? Who is the one person in this world that gets to do what they want? Hot girls with big boobs. That's it. That's the only person that gets to do whatever they want and be whoever they want to be and can get an easy job where they do absolutely nothing at all and somehow make a living wage, or better yet, make a six-figure salary doing that. Hot girls with big boobs are the only ones that get to do that. And the reason why is because everybody wants to have sex with them, and that's it. But you and I, the average person, We don't get to do that. We don't get to be what we want, despite the fact that our parents all said, oh, you can do whatever you want. And our guidance counselor said, oh, you can be whatever you want. And our teacher said, this is America. We can be whatever we want. And I was watching like this documentary on Shawn Michaels, because he outed myself here. Yes, I was a wrestling fan when I was a kid. And Shawn Michaels had said he wanted to be a wrestler so bad that he just kept going down to the gym where all these wrestlers were training and said, hey, I want to be a wrestler. I want to be a wrestler. I want to be a wrestler. And he kept doing that for months. He kept doing it. And finally they said, okay, it's clear you really want to do this. We'll let you do it. Does that happen in America anymore? Can we do that? No. No, you can't do that. The only thing that you can do in this country, unless you're a hot girl with big boobs, the only thing that you can do is what's in demand and what you're good at. Most of us millennials didn't live by that rule. We did stuff that we thought was fun. So we got liberal arts degrees, or we majored in being the facilitator at DEI seminars instead of learning something useful like accounting or engineering. So post-graduation, what do? They beg for jobs that don't produce anything. Because a DEI consultant does not produce a damn thing. A liberal arts major does not produce a damn thing. It adds nothing to the economy, so they get what we call make work, fake work jobs. HR is one of those make work, fake work jobs. We don't need HR. We really don't. And it's all just a welfare jobs program to employ stupid people. That's all that HR is. And who funds these gigs? Most of the time, it's Uncle Sam funding all of these jobs with their endless deficit spending on essential nonsense to keep stupid people employed and off of the public dole. Now, the irony here is that the spending that they're doing may as well be welfare on the public dole. So, when you see a stupid person, that person is literally costing you money because the government is doing more deficit spending to keep that imbecile alive, and it's costing you more money. You want proof of this here, that we're just not producing stuff? That we're just not creating brilliant minds in school to come up with brilliant things, to produce things that the world needs? I mean, for one, just look at housing. They keep saying, oh, there's a housing shortage. There's a housing shortage. We didn't produce enough carpenters and architects to build houses, so that kind of makes sense. We don't have enough of them because we had too many liberal arts majors. They didn't build enough homes. And then also we got Karen at the HOA with her NIMBY laws saying, I don't want anybody building these starter homes in my backyard. Okay, Karen, well, enjoy having your son live in your basement for the rest of his life. Do you need proof, though, that there are more make-believe derivatives of work than actual producers out there? Because I do got the proof. Check this out. For the first time in the history of the investing world, look what we got here. There are now more stock ETFs than there are stocks. And you say, well, how is that proof? Like, what's the connection there? I mean, I don't get it. Here's the connection. This means there are more investment vehicles piggybacking off of positive economic producing companies than there are positive economic producing companies. We ran out of people willing to work and take risks. So now we make investment companies, ETFs, to mooch off of the people that already exist. This is why we have the deficit spending, because there's just not enough people doing useful stuff, and we got to keep everybody alive. So we keep spending to keep the people doing useless stuff alive. And that comes at the expense of people doing useful things. And if you stop the spending, well, then unemployment is going to skyrocket. And all those former baristas with PhDs are going to become net drains on the economy. I mean, they already are net drains on the economy, but they're going to become any more obvious net drains on the economy that makes a politician look bad because they'll be sucking up welfare but not contributing a thing. So it's a vicious cycle. So you spend on useless crap to keep people employed, or you watch the system implode. You need proof of this is going on right here? I'm going to give you the proof here. Remember Elon Musk's Doge crusade that was uncovering fraud? And all those proposed cuts? Not a single one of them happened. This is why Elon was so mad and why he was like running around starting a fight with Trump and saying he's in the Epstein files and all that. This is why. I mean, I don't blame him. I don't agree with him, but I don't blame him because he really took a risk there. He put his name on the line. He put his company on the line. His company was getting their dealerships vandalized, their vehicles vandalized for the work that he was doing that he truly believed in. And he worked his butt off finding all of the fraud out there. And he presented it to Congress saying, hey, here's all the fraud. Let's cut it. And Congress just said, hey, Elon, F you. F you, Elon. We're not going to do those cuts. We're going to keep them going. So I can understand why he's angry. Why did Congress do that? Because even axing something like fraudulent SNAP benefits, food stamps, that would be like taking a hammer to Walmart's knees. Because 5% of their revenue at Walmart comes from food stamps. If you hurt Walmart, well, then suddenly you're the villain who tanked all the jobs at the local superstore. It's economic Jenga. You pull one block and the whole tower wobbles and falls down. That's why. So you might be asking me, like, well, how can they keep allowing this crap to happen, especially when it was fraud? And they're still funding the fraud. This is why. It's because the economy is depending on fraud. I mean, just this chart that you're seeing right here. More ETFs than stocks. That's more value mooching than value creation. It's not just inefficient. I mean, this is just this alone here with more ETFs is going to cause distortions in the stock market. Because when you've got ETFs that are ran mostly by computers and algorithms being forced to buy certain stocks just because money's been stuffed into them, are the valuations and price discoveries that we're getting in stocks appropriate? No. No, they're not. They're overinflated, specifically because of all this. This isn't just inefficiency. It's wealth transfer disguised as governance. You see, the government's bloating to 44% of the economy, and that means we're all trapped in this loop, sending cash to Washington just for them to send it right back to where it came from, with a bow on top, minus a cut for the bureaucracy, of course. But here's the thing. In this screwed up economy that we got, the deficit's not a bug. See, the deficit's a bug in our household, with our budget, our household budget, but not with the government, not with the U.S. economy. Because you see, without them, the whole economy crumbles. No jobs for the underqualified, no revenue for the Walmarts of the world, and a recession that makes the last one look like a tea party. That's what we'd be facing. But hey, at least it's sustainable, right? Until it's not. You see, you keep this up, and we're heading for a wealth gap wider than the Grand Canyon. And crypto and assets are the only escape hatch for those smart enough to jump the ship. So, U.S. spending is a snake devouring itself, funded by treasuries, spent on fluff, and repaid by taxes. Not enough taxes, though, to cover all of the bonds. So we're running up deficits to prop up a generation of unproductive idiots. And if you cut the fraud, that hurts the corporates. If you stop the spending, then we got an unemployment apocalypse. It's all a system built on denial until it snaps. But let's go back to the snake eating its own tail. What if right here, the treasuries, what if right here, the money that was being used to buy these treasuries wasn't money that came from the private sector? What if the money they were using to buy these treasuries was money that was printed out of thin air? So it's not from the private sector. It's not extracting from the economy. The snake is still going to eat its own tail when it collects taxes later. But what it does here when we print off new money to buy the treasuries initially, what that does is that means the snake starts pooping out a bigger tail for it to eat. That doesn't fix the problem, but it keeps the impending death that this problem is going to cause from happening. It delays it longer. All right, so just think of it like this here. While this snake is eating its own tail, eventually it's going to go all the way up to the neck. But if instead of extracting money from the private sector, with treasury bond issuance. Newly printed money buys those treasuries. What happens is the snake's tail gets longer, and that gives more for the snake to eat. That keeps the problem at bay for a little bit longer. Like kicking the can down the road. As what I say, money printing is just kicking the can down the road. That's what they're going to do. They are going to print more money because it's the only way that they prevent the big disaster that this snake could be bringing to the world, collapsing the entire world. And that's what the stable coins will do for them. Thanks to the Genius Act, now we have a snake that is eating its own tail, but it's making the tail bigger by pooping a bigger one out, because the Genius Act is now telling all the stable coin issuers that they must buy a treasury to back up the stable coin one for one. So that way, when somebody's using these stable coins, they know that when they get out of it, they'll get their dollar back for every coin that they cash out. That's something that I do want to cover in greater detail. I thought I was going to do it today, but I need to do more research on the subject as far as like how stable coins are going to cause more money printing. But here's what we want to know is that when markets tank, they print like it's the law. So the bond market's having a tantrum because you see yields are spiking worse than a bad fever and volatility's jumping around like a caffeinated toddler at a birthday party. What do the governments do? They don't just sit around and think about, oh, maybe we should do some austerity. No. You see, there's a great video by Ray Dalio that shows you just how the economy works. You just look at Ray Dalio, The Economic Machine. And it says, well, sometimes they've tried austerity and it's not helped the economy. That's like we were saying earlier, the cutting that they should have done, the Doge cuts. Why they didn't do it? It's because austerity is not going to fix this. What is going to not fix it, but put a Band-Aid on this problem, is firing up the money printer. Like it's a 3D printer for dollar bills. So every time markets wobble, especially bonds, the Fed, the Treasury, and all the politicians, they trip over themselves to flood the system with cash because nobody is going to vote for the politician that gets out there and says, hey, let's all just suffer for a bit. Because if we were willing to suffer, we could never have this problem again. If a politician got up there and said, hey, life's going to suck for the next 2-3 years, but I'll tell you what, it's never going to suck again for at least another 100 years because we got all the pain out of the way by fixing our system. If a politician did that, they'd be ran out of the country. Be like trying to sell kale-flavored ice cream. Nobody's going to buy that. So this brings us to what they're going to do now, which is capital controls. Latest brainwave here, the idea from the Trump administration now is capital controls. Or at least it's the idea of like whoever's advising the president. See, the U.S. has been exporting dollars like they're these cheap knockoff handbags that you buy off of Temu or Shane. But foreigners are starting to ditch them. So what's the plan? They want to slam the brakes on capital flows, making it harder for those pesky foreigners to yank their money out of U.S. assets. It's like locking the doors at a bad party. Nobody's leaving here until we say so. And the result is that the Treasury and Fed are going to print even more dollars to replace the fleeing capital. And guess what happens next? That means gold and crypto go absolutely bonkers. They start soaring to the roof like they just discovered Red Bull. Now I'll talk about Ethereum. Because you see, Ethereum is like the crypto equivalent of a friend who's always just chilling. But now they're kind of like sprinting, like they're late for a job interview. Why is that? Some say it's the Pectra upgrade. Or Vitalik has been tweeting again. Or maybe it's just human nature. You know, people hate something so much until it becomes the underdog that roars back. The real answer is this. Mean reversion. Mean reversion. When something is sold down, it gets transferred into more convicted hands. I heard this from Access Alive once, and it was the greatest explanation of bear market functions I've ever heard in my entire life. When the bear market comes along and people start selling their coins, you know what's going on there? What's going on there is actually a good thing. The weak, pathetic fools who are selling their coins at low prices, getting out, good, we want them out. They're getting out. But the people that are buying it are stronger-handed people because they're willing to hold this asset at a lower price. Because you see the sale order that's coming through from the person that's dipping out, they're pushing the price down, but still these stronger hands that are coming in and buying it, they're willing to hold it. That tells you right there that it's stronger hands. Like when Hex was at 55 cents and then it started going down. Like a lot of people wanted Hex at 55 cents. A lot of people wanted it. It was the top. A lot of people bought the top. But not too many people wanted to buy it when it went down to 36 cents. Except people with more conviction and belief in Hex. They were the ones buying when it got sold down to 36. And then when it went from 36 to 1 cent, there were people buying it at 1 cent. A lot of people were okay with buying it at 36 cents. Not too many people were cool with buying it at 1 cent. But the ones that did buy it at 1 cent, they did it because they had more conviction. And I think a lot of those people that bought it at 1 cent are still holding it right now. And I'm talking about EHEX. They're the ones that are still holding EHEX right now. All right? Because a lot of them were stakers. So, what am I bringing this up here for? Mean reversion. More convicted, stronger hands hold it as the less convicted hands sell out of it. So this isn't just a fluke. Market is telling us that crypto's back. The most hated assets will be the ones that climb the fastest, like a zombie rising from the grave. So if you're still short in ETH because you think it's dead, you're going to be like the guy that bet against Rocky Balboa. Now, let's take a look here at why we're in this mess. Think back to World War II. Or better yet, think back to post-World War II. 1944, the Bretton Woods Agreement. If you haven't heard of the Bretton Woods Agreement, this is something you really want to study. You really want to know inside out because it really dictates like why we are at where we're at right now with the money situation. Probably the most important piece of money governance that has occurred, at least in the 20th century, the Bretton Woods Agreement. You see, the Allies, fresh off of beating the Nazis, they sat down in some posh New Hampshire retreat, carve up the world's economy. And the U.S. was there saying, hey, everybody else, all you other countries, you should peg your currencies to the dollar, and we'll peg the dollar to gold. Deal? And a lot of people, they all agreed. Here's why. Everything that the United States has, like why is the United States the superpower that it is, all of that, we owe that 100% to the Germans misbehaving and starting World War II. The reason America became as great as it got was because the Germans misbehaved and started World War II. Because when Germany, Nazi Germany, started misbehaving and doing the dirty stuff that they were doing, a lot of other European nations and others in the region said, oh man, what if the Germans invade our country? Keep their sovereign gold, and they did. We had the world's gold at the time. And so at Bretton Woods, we said, let's back up all of our dollar bills with that gold. And it was a power move, letting the U.S. rebuild Europe, rebuild Japan, rebuild the world, while keeping Russia, the Soviet Union at the time, in a geopolitical timeout. And it worked like a charm until the 1970s, because you see what happened was, in the 1970s, World War II was over, of course. There was no longer a threat coming from Germany or anyone else in the region. And so a lot of these countries said, hey, we want our gold back. We want to get our gold back. And we didn't want to give it up because then the United States would lose its superpower position. And that's when Nixon in 1971 said, oh, yeah, we're not going to face this gold drain with the Vietnam War and the French demanding their gold back. We're going to say, hey, you know that gold standard that we said we'd adhere to? Screw that. There's no more gold standard anymore. We're not keeping up with a gold standard. No. So they severed the gold standard. They severed the relationship between dollar bills and gold. Now we have the petrodollar, because you see in 1971, the U.S. struck a deal with Saudi Arabia that says if you sell your oil in dollars and park the profits in U.S. banks and buy our treasuries, well, then we'll keep your deserts safe with our shiny weapons. Little there. And that's how we ended up with the petrodollar that we have now. Basically, I ask what backs up U.S. dollars right now? It's petroleum. Oil is basically what backs it up. But fast forward to 1994. Well, oil became the new dollar's backbone. Everybody else needed dollars to keep their economies humming. 1994, China had a big moment where they said, hey, the United States, they did the petrodollar. Well, let's do something similar. Let's have a yuan. I think it's yuan. Is that how we say the China currency? Forget exactly how it's about. Yuan? I think it's yuan. All right. So Deng Xiaoping and their crew devalued the yuan and turned China into a manufacturing juggernaut. They started hoarding treasuries like they were Pokemon cards. And the Asian tigers followed suit. Everybody else in Asia, they started doing the same thing. They started exporting cheap goods, stacking U.S. dollars, while the United States financialized its economy and outsourced manufacturing to anyone with a pulse in a factory. But here's the twist. This system screwed over the bottom 90% of Americans because good jobs vanished. The manufacturing factory jobs, they disappeared, and they were replaced by what we got today, which is gig economy hell. DoorDash drivers and Uber hustlers, OnlyFans. That's why Trump's back in office, because he was waving the let's reindustrialize America. He was waving the flag that said that. And why the U.S. is now flirting with a new monetary phase, and you can call it national capitalism, which is where we're buying, the United States government is buying stakes in American companies, like they just did with Intel. That's nationalism, really, not so much national capitalism, because I don't think we're a capitalist country when 44% of our economy is government spending. You could also think of it as financial repression, but you see, the reason they want to do this is not because they're communists. The reason they want to do this is because it's a middle finger to the petro yuan. All right. So what's happening right now is a great divorce between China and America. You see, the U.S. and China are like a couple that's been bickering for decades, and now they're splitting the furniture. First, Trump tried tariffs on Liberation Day. They slapped a 10% tax on everyone, but 34% on China. And the markets lost their minds, and the shelves emptied. The prices spiked up like a bad fever. But then May 12th, after a tariff tit for tat that hit 145% on China, both sides blinked and agreed to a 90-day truce back to 10% tariffs. And why is that? Well, you see, tariffs are kind of like political kryptonite. You know, you raise the price of a hoodie that you can buy off of Temu or Shein by 200%. Well, the voters are pretty upset with that because they like their cheap stuff. So Trump's team learned that lesson the hard way. You can't really reindustrialize America if your voters can't afford a cheap hoodie off of Temu. So what's next? What are they going to do instead? What they're going to do instead of tariffs is now capital controls. Instead of taxing imports, they're going to tax foreign ownership of U.S. assets like stocks, bonds, real estate. You can think of it as like a 2% yearly fee on the $33 trillion of foreign investment in the U.S. markets. So $660 billion a year would come from that. That's enough to ditch income taxes for 90% of Americans and sell it as sticking it to evil foreigners. So a political layup. It's the same goal as tariffs, which is fixing trade imbalances, but without the empty shelves. And Texas already banned China, Iran, North Korea, and Russia from buying land. And that's a classic capital control move. It's like saying, you can sell us your cheap TVs, but don't even think about buying our dirt. Now, here's where it gets juicy. See, capital controls mean foreigners will sell U.S. assets like stocks, bonds, property, because they want to avoid the tax. And that tanks the markets, which is what we're seeing right now. And it's spiking the bond yields. We're almost at 4.3%. We have flirted with 5% in the past on the 10-year Treasury. That sends volatility through the roof. What's the Fed's response to this? The Federal Reserve, how do they respond to that? They print money like a photocopier on steroids. That's quantitative easing. It's coming back. Jamie Dimon's already talking about it. Quantitative easing is going to come back. It's going to really start with the Federal Reserve buying up treasuries. You see, the Fed's sneakily been buying up 10-year bonds while pretending to do quantitative tightening, keeping the yields from going full apocalypse. Because really, if the Fed wasn't buying any 10-year bonds, any 10-year treasuries, yields would be over 5%. But that would be bad, bad news for the overall economy. Scott Bessent, the Treasury Secretary, he's out here trying to sell treasuries to anyone who will listen, like U.S. banks, pension funds, and stablecoin issuers like Tether. But you see, nobody really wants the long end bonds. They're all snatching up T-bills like they're free samples at Costco. So in order to get those long-term bonds bought up, the pressure will have to be put on the central banks to do that. And that's quantitative easing. So this is crypto's big moment. Foreigners start dumping their treasuries. The dollar weakens. And then crypto and gold go parabolic because they're the only assets you can trust when the government starts playing silly buggers with capital flow. And you see, crypto, it's not just a tech bro fantasy. It actually is a hedge against a world where the U.S. and China are carving up the global economy into rival blocks. I mean, I think it was Russell Napier. He has said that we're headed for like a dual monetary system where you got a U.S.-led block with controlled dollar and then a China-led block that may be backed by gold. But you see, if you're smart, you don't bet on either. You hold Bitcoin and you hold crypto and you hold gold itself because they move between systems without asking permission. And I got something to say. Crypto and gold, something special right here. Whenever you're in an argument with a hater, especially a hex hater, I'm going to give you the one thing you need to say to win that argument every single time. I hope you're listening right here. I hope you're listening because if you know this, you're never going to lose another argument about crypto. All right. So Bitcoin, could it become the global reserve asset? I don't think so. The median central banker, they're like a 60-year-old in a suit, and they think blockchain is just some new type of spreadsheet. But gold's been a neutral store of value for centuries. Bitcoin, it's not old enough to be a store of value to a lot of these bankers. The institutions, they really understand gold. They don't really understand crypto yet. Maybe in 20 years when people who are 35 years old today are running the show, those people will make Bitcoin be a bigger thing than it is now. But that said, the macro setup is this here, and it's a wet dream for crypto people. Money printing is coming because capital controls are tightening. The China-America divorce is pushing capital into non-custodial assets. Like right now, Bitcoin, where is it at here? Is it still at 109,000? Or did it go down further? Let's have a look here. $110,000. It went right back up. All right. A little bit of a moderate retrace on it there. And Ethereum, it was at 4,300. Now it's at 4,400. Still down from like where we want it to, but still, it's better off than where it was before. But here's the thing: is at 109, is at 110,000 now. We think it could be somewhere between 150 to 200,000 by year end, and it's possible that it could be 250,000 by next year. Ethereum could hit 20,000. I'm thinking that. Wendy O, though, who's usually very conservative with her predictions, she thinks Ethereum is going to go to 25,000. Now imagine the altcoins. I mean, are they just going to sit back and barely do anything while all this is going on? No! They're going to blow up too. Altcoins are going to go right through the roof when all this starts happening. Because it's all just a reflexive system. And it explained, like, what gets the bull market going, what keeps it going for a long time. I explained that a couple streams back about, when shorts get liquidated, leverage longs get taken out, and institutional FOMO, then retail FOMO all comes in. And it happens like all in a very short amount of time. But here's what I say, is you pick the projects that actually have cash flows. EtherFi, Pendle, Hex, assets, crypto assets that actually pay you something, and they don't just promise you a party in Vegas. Why those, though? Like, particularly Hex. Because these crypto assets, this is how you win the argument with every single hater. That you say, oh, Hex has no value. I had an argument with an idiot earlier today, specifically about this. He said Hex got no value because it doesn't produce anything. Oh, no. It's a yield-bearing asset. It produces a yield. And he said, well, you have to sell your Hex for that yield to mean anything. I think you just described every single investment in the history of investments, okay? But here's how you win the argument. What makes Hex valuable? Or let's start with crypto in general. What makes crypto valuable besides speculation? What makes it valuable is that crypto assets are the only asset that is not someone else's liability. Let me say that again. Crypto and gold are the only assets that are not someone else's liability. Now, I will say that about gold is like gold is a liability in the sense that you have to store it, and it's not very convenient to do that. Like you need a vault, and it can be very heavy when you have large amounts of it and everything, so it can become a liability for you. But crypto, it's not really hard to store. So it is the only asset that is not someone else's liability. And with Hex in particular, Hex is the only yield-bearing asset that is not someone else's liability. You see, with Hex, the yield that it pays comes from the code, from the origin address that's running automatically and is immutable and is going to keep paying out no matter what, so long as whether they're stakers or not, or whether Richard Hart is alive and marketing or not. Hex is still going to keep doing what it was designed to do. And it's nobody's liability. Every other yield-bearing asset is somebody else's liability. A CD, that's a liability of the bank. A bond, that's a liability of the issuer. Everything else that pays income, that pays a yield, it is somebody else's liability except crypto. It is not anyone's liability. So here's the deal. The world's monetary system is shifting. Like it's watching, think of like a tectonic plate trying to moonwalk. The tariffs failed, but capital controls are coming, and the money printer's warming up for a 2026 encore. So treasuries, they're losing their reserve asset crown. Bitcoin, crypto, gold, maybe even Ethereum will be the beneficiaries. The U.S. wants to reindustrialize, China wants to flex, and the rest of us are just trying not to get screwed. But if you hold these crypto assets that are not somebody else's liability, and if you avoid bonds like a bad Tinder date, and keep an eye on bond volatility and the DXY as your crystal ball, you will make it through all of this. You will come out on top, and that way when it becomes an I-shaped economy, well, that I-shape, you're going to be in the dot. You're not going to be in the line. So that was everything I got for you today here. Let's go to the chat, see if we got any questions. Y'all hit me up with those questions there. What do you got for me? Anybody got anything for me tonight? Y'all have been... I see like there's 32 of you watching. 34 if you include Rumble and Twitch. But anybody have any questions that you want to ask me for tonight on Macro Monday? I think I will do some more streaming this weekend. I'm not sure like what day. Might be Wednesday, might be Friday. It'll just be whenever I feel like it. But oh yeah, let me also show you this here in case you came in late. Do you want a free gift? Because you can get yourself this book 100% free. The book is called Your Parents Were Wrong, Debunking and Replacing Outdated Advice. You get it 100% free if you join my Substack. My Substack right here is reinventideal.substack.com. All of the articles on there right now are 100% free for you to read. They don't cost you anything to read them. There's no paid articles yet. There will be paid articles in the future. But you just come right here into the middle of the nav bar and click where it says free gift. Become a free subscriber. You get Your Parents Were Wrong for free. If you want to be a paid subscriber so you can read the paid articles when they come out, you will also get this book, Don't Give a Shit and Succeed. You will also get Your Parents Were Wrong as well. You get both of them if you're a paid subscriber. But if you really, really want some free stuff, you can get a third book by becoming a special type of subscriber that we call an idealist. You're an idealist, you'll also get this book here, No More 9 to 5 is what it's called. You get that book. Plus, these other two, you get all three of them by becoming an idealist on my Substack. All right. It doesn't look like anybody's got any questions here tonight. Seems like we're all good here. Oh, yeah, you know what? Let me also kind of show you this here because it kind of like drives home the point that I was making earlier about crypto is an asset that is not somebody else's liability. So this fool here on Twitter really wanted to like look smart and everything and say, oh, crypto's not an asset because it doesn't produce nothing. It don't have no value because it don't produce nothing. As if something has to produce something to become valuable. I mean, scarcity by itself can make something valuable, whether it produces anything or not. Now, I never said that cryptos were businesses that produce anything. But here's the deal. He wanted to say that shares of Caterpillar stock are valuable because as a business, they produce real goods and services, resulting in actual profit from productive enterprise, which is true. Or at least in theory, they should be producing real goods and services that produce a profit. And then he says, unbacked cryptos are casino tokens that depend on new speculators to have any value. He capitalized any to really emphasize the word any. They're not businesses and they produce nothing. Okay, well, here's the thing here. Here's the flaw in your thinking here, son. One, owning shares doesn't guarantee you any profits. You only get some shares if the board of directors declares, or you only get a dividend. You only get some of the profits if the board of directors declares a dividend. They only do that if they feel like it. And a lot of times they skip dividends, at least for the common shareholders. So you're at the mercy of a middleman that crypto was invented to eliminate when you buy shares of stock. And you getting any dividend depends on the accounting method that they use to determine if there's a profit. Because in a world where there are greater tax benefits for a company to report a net loss as opposed to a profit, they're not going to have profits to pay you a dividend from. And then three, if the dividend is paid, you're only getting your own capital basis back. I explain this in my book, The Financial Red Pill, that dividends really are not new money coming back to you. A lot of it is just you getting your own money back, your own capital basis, and you're getting taxed on it. You're not supposed to get taxed on your basis, but you do get taxed on your basis when they pay you back a dividend. Because you see, if we got a company stock that is worth $15 and they pay you a $1 dividend, your stock is going to go from $15 in price to $14 in price after the dividend is paid. So you lost money there because the dollar in dividend that they sent back to you, you're going to have to pay taxes on. That's a net loss to you. This is why investment literacy is so important, so you don't look stupid like this guy did. Fourth, the real draw to stocks is that make capital gains, which depends on the exact same speculation that you criticized about crypto, bro. You could do preferred stock shares, but those have no capital growth, no dividend guarantee, and what dividends they do pay are dwarfed by inflation because the rates are so low on them. And then lastly, stock shares are generally a liability of the company because if they don't please their shareholders, those stocks will go down. So that makes it an obligation for the company because a lot of people that work for this company receive stock shares as payment or stock options, especially the executives. So it is a liability of the company because I got to keep the shareholders pleased. Crypto, however, is an asset that isn't somebody else's liability. That is what I want you to take here from this. That is the most important thing for you to learn from this stream. Crypto is an asset that isn't somebody else's liability. All right, I've got one question here. What's shaking hexagons? Let's take a look here at the hex price. Like how low has it gotten here? Let's see. Over to Go Pulse. Let me refresh it. Make sure this is the latest pricing. All right. So it really hasn't moved much from where we were at the beginning of the stream. It's at just under 1 cent. This here, I don't think we can really say that there's anything specifically spooking the hexagons right here, because being down 4.3% as opposed to the rest of the crypto market over here, we'll look at. I mean, Bitcoin is down almost 3%. When Bitcoin is down that much, the alts are going to take a bigger hit. So Bitcoin down almost 3%. We're only down 4.3%. That is actually good to have a gap that small, because look at Ethereum. Ethereum is down 8% when Bitcoin is down 3%. So we're not even down as much as Ethereum, and Ethereum is the number one altcoin out there. So why are we down? Really, it's just a matter of like the whole market is down, and it's all connected because we're all got all these liquidity pairing all over the place. So we're down just because the overall market is down. I know that that's really hard for Ivan on tech to understand, because he keeps going, oh, Puthicans, why is your coin down when the entire market is down? He says this because, I don't know, he just has a hate boner out for the hexagons and the pulsicans, and he's constantly trying to kick us when we're down. I'll tell you what, man, I cannot wait to just rub it right in his face when the biggest green candles, when the biggest green bubbles are from Pulse and from Hex, because you know he's going to have a really hard time accepting that. Here's how he sold all of his Pulse, and he sold all of his Hex, and he's been mocking it ever since, thinking that that was like the greatest trade that he ever made in his life, and he's going to look like the biggest imbecile in his life when the money printer gets turned back on. So that's all I got to say here for tonight. You guys, we'll see you later on this week. Cairo out.